The ABC of peer-to-peer credit. The financial world hasn't witnessed much innovation since the 2008 meltdown. This is because any innovation in this sector is scrutinized for possible systemic risks. However, during this period, peer-to-peer lending has evolved. The industry is still in a pretty infant stage. However, in 2015, peer-to-peer credit accounted for over $5 billion in loans. This represents an almost 100% increase on a year-on-year basis. Also, in the forthcoming year, a 72% increase is also on the cards. If this trend can be sustained for just a few years, peer-to-peer credit will become a significant player in the credit markets. Banks and other financial companies are also looking at peer-to-peer lending as a method to diversify their tightly monitored portfolio. This is likely to fuel the peer-to-peer growth even further. How is peer-to-peer lending different? Peer-to-peer lenders do not lend money on behalf of the investors. When we lend money to a bank, the bank acts as an intermediary and invests money on our behalf. On the other hand, a peer-to-peer lending platforms plays the role of a matchmaker. These companies have developed a platform wherein customers need to enter their information. They then have proprietary algorithms which will assess the risk in the requested loans. Based on the risk evaluation and interest rates, the loan opportunities are then presented to the investors. Investors are aware of who they are lending money and for what. Also, they are directly accountable for the loans they make. The peer-to-peer platform just acts as the middleman. For the consumers, peer-to-peer lending is different because it gives them access to credit that would have otherwise been difficult to obtain on similar terms. As far as the investors are concerned, peer-to-peer lending is different because it gives them an unprecedented amount of control of their investment, and also the interest rates are considerably higher. How do peer-to-peer credit companies earn revenue? Peer-to-peer companies have a different revenue model. They do not make their money on interest rate differential. Instead, they charge a finder's fee to both the buyer as well as the seller. Also, they take a certain portion of the interest that is paid on the loan as commission. Collaboration by banks. One might assume that banks would be fighting tooth and nail against the peer-to-peer lenders. However, this assumption doesn't hold ground. Any kind of analysis will show that banks are indeed cooperating with peer-to-peer lenders. About 80% of the dollar value of the loans made by peer-to-peer lender is not made by individuals. Instead, it is made by organization. A large number of these organizations are banks themselves or subsidiary companies that are owned by banks. Banks, therefore, are simply using the platform provided by peer-to-peer lenders to make small dollar value loans that are too expensive for them to make if they use their own infrastructure. There is, however, a flip side to bank using peer-to-peer lending. Modern banks rely on customer service to retain their customers. Also, cross-selling is a huge part of the banking business. Peer-to-peer lending makes the banks offer white-label funds to borrowers. As such, they cannot demonstrate their customer to service or attempt to cross-sell when they make loans using a peer-to-peer platform. The innovation. Different evaluation. Peer-to-peer loans use a different credit scoring mechanism as compared to traditional banks. Therefore, people who are disqualified from traditional loans may obtain a peer-to-peer loan quite easily. Option to buy loans. Peer-to-peer platform offer investor with a wide array for option. They can decide whether they want to exclusively fund the loans or whether they only want to fund a part of it. Also, they can decide the geographical and financial boundaries within which they want to fund loans. Thank you.